Good afternoon, everyone, and welcome to today's Competitive Intelligence Community of Special Library Associations featured webinar, CI Toolkit Financial Analysis, featuring Ryan Macumber, and myself, your moderator for the day, Rosie Lindquist. I'd like to start off by saying thank you to our sponsor, Aurora WDC, for sponsoring this webinar, and to let you know that this webinar is just one of many fabulous content-driven presentations that the competitive intelligence community has pulled together. Look for additional webinars coming in the future, as well as some fabulous content for the upcoming Special Library Association conference in August. We hope you can join us. Next, please. So just a little bit about myself. I am an information research scientist at the Hershey Company, and my team is responsible for providing scientific and technical research to support global R&D. Next, please. Okay, so just a few quick announcements related to the competitive intelligence community, and then we will move right along with the webinar. So we are introducing something called Member Monday Spotlight. This is an opportunity for us to get to know you better. So we want to hear from our members how the competitive intelligence community has helped you professionally, if you have favorite webinar topics or things that you've learned at our sessions, or any sage wisdom that you wish to share with other current members or potential members. There will be a link in the chat panel where you can submit your comments. Next, please. And we want to hear from you about how you want to enhance your competitive intelligence toolkit. So what type of skills are you looking to add to your toolkit? Do you have any knowledge gaps? Are there any webinar topics that you would like to see? Please put your responses in the questions panel. We would love to hear from you. Next, please. And just two upcoming dates. Today, the registration opens for the SLA annual conference that runs from August 4th through the 13th. That conference is virtual, so you can attend all the presentations from the comfort of your home or your office. And we also have another CI Toolkit webinar coming up soon in April. That topic is to be announced soon. Next, please. And just some great commentary on some of our webinars that we've gotten. That the recent CIC webinar was a great window into what 2021 can bring. With so much uncertainty from the 2020, it was great to hear from a panel of experienced CI researchers on the challenges they faced during the pandemic and the opportunities they see in the upcoming year. So that was one of our previous $25 winners. And just a reminder that as an attendee today, that you are going to be entered to potentially win $25 as well. We'll let you know after the webinar. And here is our live tweeting hashtag if you wish to comment while you are enjoying the webinar content. Next, please. All right, and now without further ado, I will introduce Ryan. Ryan Macumber is the Senior Director of Market Intelligence at Best Buy. He has worked for Best Buy for 14 years in the market intelligence space since 2011. So without further ado, I will turn it over to Ryan. Thank you.
Awesome, thank you, Rosie. Thanks for having me here and for everybody taking time out of their day to talk about the topic of finance. That's always a good show of support for the practice. So as Rosie mentioned, we'll be talking about not just finance itself, but how you can apply it more to your as a CI as part of your CI toolkit for competitive intelligence. So first, I will kind of walk through a little bit of company and team background, and Rosie will as well about her company and team. Then we'll get into a little bit of context setting. So why can finance be helpful as a CI tool? What are some ways to think about it maybe differently than the traditional sense? And then we'll talk a little bit about how you can work with finance, meaning the finance folks in your company, possibly working with them to partner to build out maybe new capabilities, new ways to get at a different understanding of your competition through a financial lens. Then we'll walk through a case study. Okay, company and team background. So a little bit about Best Buy. First here, quick history lesson on Best Buy. So The company started in 1966 as Sound of Music, which is kind of interesting. I'm not sure how many people know that, but founded by Dick Schultz. And interesting enough, in 1981, an original Sound of Music store was destroyed by a tornado. And that led Dick Schultz to have the idea of, well, why don't we just kind of sell everything at kind of a fire sale? And a customer commented to him, to my understanding, that they were coming to get the Best Buy. So that kind of the tornado actually changed the direction of the company way back when to what we see today as Best Buy, and this kind of prompted the big box concepts for the company. Changed the name in 1983, and then you can kind of see the evolution of logos that we've been through since. Most recently, the 2018 logo kind of coincided with kind of a branding change, customer segmentation, deep dive, a little bit of more customer-centric approach to the company. Fast forward to today, as a result of some of that work, we have what we call our purpose, our rallying cry, and guiding behavior. So the purpose is to help customers pursue their passions and enrich their lives with the help of technology. Rallying cry, which you'll see kind of in parts of these slides, is let's talk about what's possible. And then guiding behavior is kind of maybe a little bit behind the curtain of how we try to operate internally, is be human, make it real, and think about tomorrow. And I just wanted to throw in the quote from our prior CEO, Hubert Joly. This idea of, we're a for-profit company, Fortune 50 company, publicly traded. We have to make money, but it's not a purpose in and of itself. Making money is more of an imperative. In his mind, the company's purpose was to contribute more to the common good, and then good things happen after that in terms of making money. So it's kind of informed kind of the mindset of the employees at Best Buy going forward. Okay, moving on. I always think it's interesting to at least, market intelligence capabilities sit seemingly in lots of different parts of companies across different industries, across different companies. So this is kind of a highly simplified view of the org structure within Best Buy, and you can see where market intelligence sit. So you start with the CEO, Corey Berry. We're located in the customer office under our Chief Customer Officer, Allison Peterson. Within there, we have Experience Design and Insights group led by Jenny Weber. And then within there, we're part of the enterprise research group in particular. So we partner closely with our primary research folks, the ones who are talking to customers, doing focus groups, taking them on the deep customer segmentation work, et cetera. So we kind of work closely with them. One call out here that is, I think is pretty cool, in an area that Best Buy has tried to focus on more, is if you look, at the kind of layers above the market intelligence group, they're all women leaders. And it's just super cool kind of to see how the company has kind of evolved and come along and really focused on kind of that diversity of leadership. Still a lot of work to do, but the company has definitely come a long way on that front. And then Rosie, if you wanted to say a little bit about your team and company.
Sure, Ryan. So my group, Technical Intelligence, we actually report through research and development. So our the primary recipients of our research are members of R&D or part of R&D. However, we liaise with several other departments, including strategy, mergers and acquisitions, and our supply chain group. So our reach is much broader than solely R&D. Thank you. And just one other comment that I forgot to mention at the beginning, my apologies. If you have any questions, attendees, please feel free to drop them into the chat box and we will address them at the end of the webinar. Thank you so much. Thanks again, Ryan.
Okay, thanks, Rosie. We'll get right into it here. First, some context setting. Why finance? We'll talk about that in a minute, but first, I always find it helpful to kind of gauge, maybe where you're at on the finance spectrum. To what degree might you want to learn more about finance, or maybe you need help from your finance partner. So clearly, the best way to do that is with the top 10 list. So quickly, we'll go through this. Just be thinking about these as these pop up. So if you can't spell 10K or 10Q, try to look for the cash flow right at Disney World. Your balance sheet goes in the linens drawer. You think net present value is the amount to spend on your kids during the holidays. You think an abacus is a character in To Kill a Mockingbird. You only think about the SEC during March Madness. You think hogs is a style of wooden shoe. You tried to trade 50 basis points for a prize at Chuck E. Cheese. You think Alan Greenspan is a 24/7 news channel. And especially if you wonder why some profit is gross, if any of these resonated, then pay attention. All right, off we go. To set a little bit more context, now that that's out of the way, I think it's helpful to think of finance as its own language. I think we we see the metrics and we see articles on it, but it really is a language supported by its own set of metrics. And it's helpful to draw some parallels to some other industries. So for example, you go to the doctor's office, you go to the hospital, there's this medical language, and there's a set of metrics that doctors use to gauge the health of a person. You know, in kind of a similar parallel, finance has its own language and is also a set of metrics used by investors, analysts, even, you know, leadership in the company to understand the health of a company. So thinking of it in that way maybe helps kind of break through a little bit of the mold of, you know, it's not just a hard set of numbers, it is actually a language and purely a set of metrics to help kind of gauge the health of an entity. And then just want to reinforce too that this is by no means a finance 101 course. The goal isn't to teach finance, more so it's to help you think about finance as a part of the broader CI toolkit. So kind of adding finance or kind of getting a little bit deeper into the finance, part of the CI toolkit helps you with things like breaking competition into digestible portions, identify key performance metrics and vulnerabilities, create early warning systems by identifying KPI trends and deviations, connect better actions to results. This is something we'll get into a little bit later, but that may be the most powerful part of this. And then scenario plan, you know, simple things like, you know, if a competitor might be talking about a strategy, well, do they have money for that strategy? Simple look at the finances can kind of help provide some context on something like that. Now that we've done a little context setting, we'll talk a little bit more about how you can start applying this and working with your finance partners. To do that, a framework can help. So earlier we talked about finance kind of being a language of sorts. Another way to think about financial metrics is they're nothing more than measures of human activity. You know, they measure money movements or amounts of money, but money doesn't move without some human action, and financial metrics are simply measuring those human actions in financial terms. So here we kind of have a row of people that represent stakeholders in a company. And first, at least for, you know, most companies, you have a set of customers, and the customer activity is measured by revenue. And again, I talked about all companies have the same basic imperative or goal to make money. Customers give companies money, and then the company takes the money and spreads it across its shareholders that help the company serve the customers. So here you have first in line is kind of suppliers, you know, so as a retailer, if you're a retailer, you pay vendors for products. Those show up in terms of cost of goods sold. But you also need an employee base and landlords for store locations, and a myriad of other costs and partners, power utility companies, things like that. Those all show up in selling, general and administrative costs, or more the fixed costs of the company. And then you get to financial entities, banks. Maybe you have to take out a loan to buy inventory, or you need to take out a loan to build a new location. So you have loan interest expense, not too dissimilar from like a car loan or a mortgage. And then finally, Uncle Sam comes in. You know, the government provides basic functions, roads, et cetera. So you have to pay taxes to the government, people and companies both do. So then after all that is kind of out of the way, you know, you hopefully have the money left over for shareholders, which is kind of to some degree why a company exists, is to kind of maximize shareholder value if you're a public company. So there's some decisions to be made at this point by a company with money left over. So either you reinvest it back into the business if there are profitable options. So build a new fulfillment center, invest in technology, raise wages, things like that, as you're seeing more across the landscape. And then also a lot of companies will pay back to shareholders in this form of stock buybacks or stock dividends. And then kind of at the very end of this, you have essentially what is cash flow, or we'll just kind of call it profit for simplicity's sake. Now, once you kind of established that flow of money and measures, you can start at the end or the basic goal of a company and start to work backwards to have a structured discussion about what drives a company, how does it make money. You can start break the company down into its components. And at each stage here, you can ask a series of questions that can just kind of help you think about the company a little bit differently. So at this stage, you're at the very high level of just how the company makes money. That can be very telling just to think about. Is the company making money? If it's not, why not? If it is, why? What's driving it? How does it generate money or cash flow? This can be very telling, as we'll get into a little bit later, about the strategy of a company. What are some vulnerabilities keeping it from generating cash flow? If it's not making money, there's probably a reason. Either maybe something controllable or uncontrollable in the company's operating model. Just kind of reinforce asking questions along the way here can really help you drill into what's driving a company, what are its vulnerabilities, et cetera. So kind of moving along the framework, what we call the financial path. You have a series of financial metrics that we walk through. So revenue, customers, and then variable costs and fixed costs. And then the remainder go to shareholder in terms of shareholder returns. So now you're breaking kind of how the company makes money into components. With revenue, you can get into things like number of transactions, revenue per transaction. For variable costs, you have things like cost of goods sold, like we talked about. So these are costs that really move as a company grows or as a company generates more revenue. These variable costs kind of move up or down with revenue, because these are things that directly supports the company's sales initiatives. Hourly labor, so maybe you have to flex your labor force up and down based on volume during seasons or just how the company is doing in general. Moving into the fixed cost component here, you have things like facilities costs, management costs, costs that are largely independent of revenue. They're there as kind of a baseline capability for the company. Another series of maybe more pointed questions comes alive here, where does the company rely more on transaction volume or lower cost to make money? Or maybe higher prices of premium products? Company operate in a lean manner, meaning they try to focus on reducing costs so they can then pass savings on to customers, or it can be more about spending money to make money. We'll get into some examples of this later. You get into even more, I would say, granular KPIs or indicators, things that drive the business that are a little bit more actionable or tactical. So transactions, for example, you need people visiting your stores, or you need people visiting your company, or you need sales leads before you can even think about making money. And then you have maybe a close rate. How many of those sales leads do you close? Units per transaction, average price, et cetera. So here you can kind of really get a sense for breaking the company's financial metrics down into more operational type metrics that you can talk about at a little bit deeper of a level. You get into things on the variable cost side, like shipping, average cost paid per product, number of employees, average wage rates for employees. So you can kind of start to zero in on, if labor costs are rising, it could be that the company's hired a bunch of people, or maybe they've decided to pay them a bunch more, each with different implications to the business. Another series of pointed questions, if the company is struggling, where and why are they struggling? Like we talked about, this really helps you kind of start to zero in on really what's going on with the company. Is the company not drawing enough customers? Does the company have too much management, too many stores? In other words, too much fixed cost to overcome? And different areas of the company focus on different portions of the financial tree. And here's where it maybe gets a little bit more real, is now you can start tying actual company actions to the KPIs or financial metrics. If traffic is down for a company, or sales leads are down, and you find that out, maybe you start looking at, have they been as promotional recently, or have they not? Have they reduced spending and awareness initiatives for marketing? Maybe not. That could correlate to traffic being down or up. Is their close rate suffering? Employee training maybe was de-emphasized or emphasized. Product availability, you can't sell stuff you don't have. Moving into some of the cost portions here, again, you can start to look at, do they have a labor model shift? Maybe they consolidated leadership positions, took on a new labor strategy to reduce labor costs, or even real estate strategy for fixed costs. Maybe they're reducing the number of locations because people are buying online more. Maybe they're building more warehouses, things like that. So again, this all ties back to breaking the company down into its components and using the financial measures to just frankly gauge human actions. Okay, so now we have the kind of tree or framework developed. Now we go back to, you have the CI team and your financial partners, and who does what. Ideally, your financial partners, if you're partnering with them, can help you kind of left to right here, helping understand a company's cost structure, maybe some of the key metrics, maybe helping you estimate if you can't get at all the information. We'll get into a little bit later sources of information. Can they help you estimate and fill in some of these gaps here to enable you to have these discussions? And then kind of right to left here, as a CI team, you're likely out there trying to understand the company's strategy, what they're doing tactically, what are their actions. And then the two can kind of come together in the middle here and kind of form a more robust conversation that hopefully takes what you're observing, and then the finance team can help you translate that into truly how is this showing up financially for your competitors. So kind of revisiting what I mentioned here, but these things are all interrelated. None of these happen in a vacuum. So at the top here, these are all revenue drivers. So you need money to operate as a company. And then I mentioned variable costs. These costs grow or shrink with revenue volume, and then fixed costs are independent of revenue. If you don't take anything else away from this section, this would be the one thing to take away is the bigger the costs are, the bigger the revenue has to be. It's not rocket science, but if you start seeing your competitor cost base rise, they're going to have to offset that with business. So if they're investing, they're going to have to get the business to offset those investments. Another way to think about the relationship of costs in a company and revenue is the idea of cost leverage. So borrowing, from a different practice here, Newton said, to every action, there's an equal and opposite reaction. In retail or business in general, to every action, there's hopefully an unequal and opposite reaction. Meaning, if you're backing up costs or if you're investing, you have to have a disproportionate reaction on the other side, on the top line, to offset those costs, to ultimately drive return to shareholders or make your stakeholders' lives better. So here, most strategic decisions involve a trade-off between generating revenue, cost, and profit. The idea is to leverage costs to produce disproportionate revenue. Some examples here would be increased advertising spend. If that doesn't result in more traffic or more revenue, then something isn't working right. Sacrificing growth margin by cutting prices. So if you lower prices, hopefully you make up for that in pure volume. So you kind of see these relational things across the financial metrics. If you see one thing happen, you should start looking for what is the offsets elsewhere in their cost structure that has to happen for it to work. Okay, let's apply this to 4 different types of retail companies. And just to note, the names have been changed to protect the innocent. So everything here on, you might find real life parallels, but these are indeed fake companies, and the numbers are all illustrative only. We have a profit fee here. How might some different retailers view the profit fee? So we have 4 example retailers here. The first one is Big Mart, which is a no-frills mass retailer. Sells a wide variety of products as cheaply as possible. Price is what keeps customers coming back. We have the Mark, which is a mass retailer as well, but more focused on customer experience, kind of open area stores. Prices are competitive, but its loyalty program, assortment offerings, and kind of welcoming stores more appeal to customers than just price itself. You have Price Club, which is a very no-frills warehouse club with a limited assortment of high-quality goods, often sold in bulk. Great customer loyalty. People actually have to pay, though, a membership fee to be part of Price Club. And then Relentless.com, which is an online-only retailer that sells some of its own stuff, but also provides a marketplace that other companies can sell on. And it basically has a limitless assortment because of this marketplace offering and its online pure play status. So some thoughts here. Each company is a little bit different. They'll have different growth strategies. They'll have different merchandising assortment strategies, different philosophies. They pay attention to different financial indicators. Again, they have the same imperative or goal of making money, but how they do that can differ across these companies. So analysts, investors, and management of each company focus on slightly different things. For example, Relentless.com, they try to offer as many products as possible. Their SKU and vendor setup is highly automated, so they've really focused on, offering as much as they can to people in an automated way. For example, they have algorithms setting prices versus humans. The opposite of Price Club, which offers a tightly curated assortment, carefully selected. You might see 1 or 2 options across different types of products. Big Mart splits the difference, and the Mark is sort of like Big Mart, but with a bigger focus on experience, fewer SKUs and less revenue. A minute here just to maybe think about, your industry or some other companies, how might they think about the profit tree differently? I think Rosie had some thoughts on this from her industry.
Yes, thanks, Ryan. Just a point call out on COGS, in that they aren't applicable to all industries. If you work in a service industry like a hotel or an airline, you might not have COGS. It might just be wrapped into your SG&A numbers. And also a cost that is important in my industry, in CPG products, as well as in other R&D driven industries, is of course the R&D spend numbers. And that's definitely an important number and is always reported separately from the other costs. So you can look at that and, see how that correlates with what a company is spending on their revenue, to see, are they really deriving potentially a lot of value from their R&D, or has a decrease in R&D spend resulted in less innovation from that company? Of course, that would require some additional digging, but there's a lot of questions that can sometimes be answered by looking at those figures. Do we have any other comments from our audience or in the chat panel about companies in your industry and how this might vary? Okay, nothing but crickets, so go ahead, Ryan.
Off we go. All right, so up to this point, this has been very focused on, trying to understand maybe one company in general. As we all know, things are better talked about in context of the industry or whatever else you have to compare things to. So an easy way to do this is what we call the Pentagon framework. Within this framework, you basically identify 5 key attributes that most companies compete on, or kind of the lowest common denominator, if you will, of competitive dynamics or dimensions in the industry. And then you can simply start to place your competitors across these different frameworks. In this case, we call it the retail Pentagon because we're talking about retailers. But here you can take all the companies we just talked about and start to group them across these dimensions and start to see maybe, in the industry, where does the industry over-index in terms of what it's offering consumers versus where are gaps, where are opportunities. So in this in this illustrative framework here, you see convenience is definitely well covered by these retailers. One has experience, a couple has assortment, price is pretty well covered, but there's this kind of area services, which is not, none of these retailers maybe are known quite for like in home or services. So maybe if you're a retailer entering the market, that'd be an area to focus on, providing more of that human interaction or human service. And now kind of taking that framework and then tying it back to comparing financial metrics across some of the different competitors. Here we have the Mark and we have Price Club. So the Mark, again, their focus is really experience and convenience. Price Club is price and convenience. And then we have 2 gross profit rates. So again, gross profit is the amount of money left after paying your vendors for products. So you have revenue and then the amounts paid back to your vendors for the products you sold. You sell a shirt for $10 and you pay $3 back to your vendor for it, for example. I'll let folks stare at this for a minute and just kind of take a guess in your head which gross profit rate coincides with which company here. All right, the Mark has this 30% gross profit rate, so higher than Price Club. Price Club has a lower gross profit rate. Well, why is that? And again, these are just numbers in and of themselves, but if you understand them in context with the company's focus and strategies, they become a little bit more telling about the company themselves. The Mark's focus on experience is more costly and therefore requires companies to drive higher margins. So they spend more on fixed costs, making more experiential stores, maybe hiring more employees per square foot. So they need to make more on every product sold. So they're probably selling at a slightly higher price than, say, Price Club would sell the same product, whose focus is prices, low margins, but made up for in volume and the lean cost structure. So the stores are pretty straightforward, simple, so they can offer lower prices, but don't expect, a super interesting customer experience. You kind of know what you're going to get with Price Club. Okay, some points to hammer home here. The most valuable part of the framework isn't actually the framework itself. The value comes from going through the framework. That's where the conversations happen. That's where the ideas spur. So just going through the framework itself can hopefully spur some different levels of understanding or different areas to dig into about your competition. Can now move into a case study of kind of applying this. This is again illustrative, largely, but somewhat related to an actual case study we went through a few years ago. At the time we had this issue where Relentless.com was disrupting the retail environment, kind of turning retail upside down to some degree. So our goal at the time was then to understand what can we know about their financial metrics alongside other sources of information, then how can that help us understand Relentless.com relative to the competition in a different way. Again, it's not about simply looking at the direction of financial metrics. It's more about understanding financial metrics within the context of the company's philosophy and strategy. So kind of from a tops-down view, some metrics we were watching at the time that maybe raise the red flag a little bit is, for one, we look at retail growth and who's driving retail growth kind of at the industry level. And over time, Big Mart was the one really driving retail growth, maybe early in the decade. But then as you fast forward to later in the decade, Relentless.com started to overtake that and almost reverse course with Big Mart. So they're clearly doing something right. So obviously that generated some interest in digging in a little bit deeper. And then what we also saw was this idea of, as Relentless.com grew, if you look at kind of retail gross profits at a high level, average across a kind of a basket of retailers, the gross profit rates were growing for a while, but then they started to level off and ultimately erode, kind of decelerate even a little bit. And while these aren't perfectly causal, we do know that Relentless.com was very price competitive and kind of forced some other retailers to maybe follow suit, and that kind of showed up in some of the metrics. Before we got into like the financial metrics themselves, it's really helpful to understand a company's philosophy first. So again, you can do things like connect the financial metrics to what you understand about a company's strategy here. And again, Rosie will share an example from her company.
Oh, sorry about that. Thanks, Ryan. Yeah, so here at the Hershey Company, we have our vision is to be an innovative snacking powerhouse. So clearly a growth mindset there. But our mission is a little bit different. We strive to be a purpose-driven organization, and that's related to both our iconic brands, our remarkable people, and also our desire to help children in need. The very interesting aspect of the Hershey Company is that, our founder, Milton Hershey, he and his wife, Kitty, left their fortune to the Milton Hershey School, which is a school for disadvantaged children. And it is a way for children from families in need to get an excellent education without any cost to them. And they remain the largest shareholder for the Hershey Company. And so our job, as a company, is to also keep supporting that school and to make sure that they continue to do the great work that Milton had envisioned when he had originally founded the school.
Awesome, thanks, Rosie. And then back to our fake company here, Relentless.com. A way to dig into, get a sense for a company's philosophy is, are there quotes from their founder or CEO? So some example quotes from Relentless.com's founder. Here, the data tells us we should raise prices, but keeping prices low helps us earn trust with our customers. So kind of going with the human view of things versus what the data tells you. Our company's vision hasn't changed since day one, so very kind of resolute with what he set up the company to be and what they are today. Always start with the customer in mind. Without them, an acknowledgement of they wouldn't exist as a company. It's a long time to build a brand, but a brand can be ruined overnight. We know we have competitors, but the more we focus on competition, is the less time we spend focusing on the customer. So right away, it gives you a sense for a clearly very customer focused, very very price focused, so they see everything they do is in service of the customer. And then their financial goals really reflect the company's philosophy. From their earnings report, they'll say our long-term goal is to optimize free cash flow. What does that mean? We do a bunch of stuff to make money, and then we invest it back into the business to improve our customer experience. And if you go way back to the starting days of this company, the founder was eating a donut one day and realized the simplicity of the circular feature of the donuts. It's kind of a virtuous cycle that came to mind. So he created what was called the circle of growth. So kind of a simple framework, but it guides the company's philosophy and strategy to this day. Just as a donut rises during the production of the donut, sales rise when this formula is followed. So you simply start with happy customers who want happy customers. That leads to sales. More sales allow you to lower your cost structure, leverage fixed costs. That in turn allows you to lower prices. And then you drive more selection, and then you have happy customers again. So it's just a very virtuous cycle. And you can see in their growth formula, you'd see parallels here to that framework, where consumers to the company will find three things: selection, price value, customer experience. The strategic focus, drive traffic, enhance selection, provide value, personalized experience. And the formula, again, is a virtuous cycle of lower costs, passing savings on to customers, but also investing in experiential improvements for the customer base. And then the strategic choices show up in this key financial metric. So cash flow, they really do focus on cash flow. So what you have here then are two components of cash flow. One is cash from operations, which is basically just the money that the business generates from its day-to-day operations. And then free cash flow is cash from operations minus investments back into the business, simply put. So for a while here, you see cash from operations and free cash flow were kind of growing together. So they weren't maybe investing that much back into the business. They were just focused on making money. But then around 2015, they had a strategic shift in how they thought about cash flow, where they really changed direction to make a commitment to invest back into the business. So they still made money from operations, but their free cash flow started to kind of decline precipitously because they were plowing more of that back into the business. And here's a quote from an actual earnings release: "We increased capital spending to build a foundation of continued long-term growth." So they acknowledged this. This wasn't something that just happened to them. It's something they kind of did to themselves. So here they're trying to provide that story to their investors, so as they see these numbers, they understand, like, this was something we're doing to build up a long-term competitive moat. You can kind of see where those two lines change direction around 2014, 2015 there. However, kind of fast forward a few years, that free cash flow line did get dangerously close to zero. So you can't dive below zero for a sustained period of time. So you actually would see some news headlines here that relate to that. Realallowance.com has invested heavily in fulfillment capabilities. That's one thing that they did focus on. Competitors try to push sellers by offering better commission rates. So Realallowance.com relies on that marketplace of multiple sellers. Well, there's other companies that are competing for those sellers as well. Realallowance.com increased annual price of its free shipping program. So this company has a very well received membership program that gives customers free shipping on products ordered for a nominal fee every year. That was one area that they thought they had some equity, that they could raise prices and customers would still kind of continue. So around 2018 there, they actually raised prices of that free shipping program. And then you see free cash flow kind of go up here, coinciding with that slight increase or slight acceleration in the cash from operations line. And apparently it turns out they knew their customers and knew what they were doing. So memberships continued to increase and actually accelerated after they increased the price of the membership program, just showing they've got their customers kind of in this ecosystem that, they had a little bit of pricing flexibility there, and still felt like they were giving customers a value, but they needed to get a little bit more cash flow going. Those investments just happened to pay off. So one popular metric for retailers or e-commerce companies is shipping costs as a percentage of revenue. So for Realallowance.com, it was growing for a period of time, but they started to invest more fulfillment centers, buying their own trucks, building out their own fulfillment network, and over time that cost started to go down as a revenue increased, and that fixed cost base kind of started to pay for itself. Add this back to the profit tree. Recall the concept of cost leverage. So what they essentially did was translate, as they invested in more facilities for fulfillment, more of their own cost structure, they turned their shipping costs from variable, so paying FedEx, UPS, et cetera, per package delivered, to fixed costs, where every package that went through the system leveraged that cost base even more. So they didn't have to rely on FedEx or UPS as much anymore. They had their own opportunity to deliver their packages. And this was actually observed in a Realallowance.com earnings call by an analyst. It looks like you've started to transition your fulfillment cost structure to more of a fixed cost to your business, leading to lower cost per unit. Then you bring in some of the other retailers and start comparing them, their financials and their philosophy. And you can see Realallowance.com, was definitely a very aggressive, again, had that decision to invest back into the business. very entrepreneurial type company. So you see it here, net income is a percentage of revenue, which is basically all the money left over before, after paying taxes and interest and such. That rate bounced around for them quite a bit. So they're making, quite a bit of every dollar of revenue, generated about, 9 cents of profits at the peak here in 2015, but then they had that strategic shift to invest more of that back into the business. So their net income rate declined, whereas some of these kind of larger behemoth steady state companies, Big Mart, Price Club, they have a pretty steady state, pretty predictable profit rate. They try to manage to that fixed number, more so than like a Relentless.com. Now moving on to Price Club, quickly understanding some of their philosophy from their CEO. We're a low-cost company. One area we don't skimp on is employee pay. We turn over our inventory fast and our employees slow. We need competition to make us better. So right away here, you see a little bit of a difference maybe in their philosophy. It's still about the customer, but they're focused on if the employees are happy, then our customers are going to be happy. So everything else is about low cost except what we pay our employees. That's what creates the experience for the customer. And then they view competition a little bit differently. They view competition maybe as a stepping stone or something that keeps them innovative. If they didn't have competition, they wouldn't improve on their own. Whereas Relentless.com is more about focusing on themselves or their own customers. Model, product mix, treasures and triggers. Every time you go into the store, it's more of a treasure hunt, maybe than other companies. They only stock 4,000 SKUs or things. SKUs are just things. For comparison, the average supermarket stocks about 40,000 SKUs. Big Mart stocks over 100,000 SKUs, and Relentless.com tries to sell everything on the planet. How Price Club makes money, their two key metrics are membership growth and membership renewal rate. So Price Club breaks even on the products they sell, so they try to manage their business at a very kind of break-even point, and then every membership due that comes in drops right to the bottom line. So their business model is to break even and then generate profit through the membership rates. It seems like they're doing a pretty good job here as they're growing membership base, and the renewal rates have stayed right around 90%. And then again, I mentioned their SGA rate, which is kind of that fixed cost base as a percentage of revenue, deviates between 7.9 and 8.1%. So pretty predictable. They're very focused on managing that cost line, whereas some of the other retailers you see here, those bounce around a little bit more. The Mark and Big Mart are pretty tight. You see Relentless.com, that SG&A rate started to increase when they made that strategic shift in 2014, 2015. So then you can move on to start looking at some other metrics that they report in their public earnings calls: store growth, total revenue, and revenue growth per store. So despite pressure to scale more quickly, Price Club, they've always had a measured approach to opening stores versus kind of bowing to pressure to build more stores too quickly, and that's driven revenue line. But one interesting thing that we try to watch is store productivity in the retail landscape, where they've had decelerating productivity per store. So that can be an early indicator that maybe they'll start slowing store growth a little bit if each incremental store is less productive. Potential things they watch: SG&A. If SG&A starts to go up or down, then you know something is probably off with the business. Change in number of new stores, change in same store sales, change in inventory model, so you can kind of see how now you can get to a set of early warning indicators for this particular competitor. Moving on to Big Mart, their founder, they're about being efficient, creates more room to make mistakes. We help level the playing field for their customers. We keep our expenses in check. That keeps you in business. We have lots of capital, but not enough ideas. So right here, it's all about the customer, but they're about being efficient. And their philosophy is we make things affordable for the massive customers. So, we might be a little bit harder on our vendors, but it's all in the spirit of making things affordable for more people. So their model, similar to Rentless: grow quickly, use scale to muscle suppliers, acquire international players, make life affordable for everyone. It's not just their tagline, but it is their mantra. So every dollar they save is a dollar that they can lower prices by. Pretty simple for things they watch: top line sales growth, cost of goods sold. So they try to manage their cost of goods sold rates, because in their mind, their suppliers are kind of in partnership with them to make things affordable for the customers. Okay, that was a lot, kind of a mouthful. We'll do a quick wrap up here before we transition to some discussion or Q&A. To wrap up, every company, even ones that appear very similar, have a different definition of winning. Winning still means, they all have to make money, but how they do that is different. Find the key metrics that your competitors monitor and manage above all others. Get help from your finance department if you can't spell 10Q or wonder why someone puts the word gross in front of profit. And then by understanding the financial performance of the company, listening to public comments, building the psych profiles of company leaders, you'll be on your way to developing an early warning system and having information to populate CI frameworks. Now, a popular question is always like, where do you get information? And Rosie has put together a nice kind of overview of kind of where her team gets information publicly and privately here.
All right. Thank you, Ryan, for that great presentation. And that was a lot of information, but some great analysis and really telling points there. I just wanted to share some of the sources that I use for the type of information that we discussed today. So the first would be sources for financial information. This would be primarily for public companies. EDGAR database houses all the SEC filings, so that would be your annual reports as well as your quarterly reports. Company websites, generally under investor information, you can find company financial filings, annual reports, also sometimes even things like presentations from investor conferences. Earnings calls and transcripts, free sources for these would be Seeking Alpha or the Motley Fool. Occasionally there are transcripts available within the investor information of the company website. There are also fee-based databases that transcribe these calls. Bloomberg, Factiva, CapIQ all have them. I find them a tremendous resource. People ask a lot of tough questions in those calls, so I encourage you to take a look at those. Investor conference presentations. So Deutsche Bank, JP Morgan, Morningstar have annual conferences for their investors where they share a lot of information about various companies. And there are also sort of industry-specific conferences. The big one for us is CAGNY, and those presentations are almost always publicly available after they are shared. You can also sometimes find slides on places like SlideShare that might have been previously shared at other events. And then, of course, business credit rating resources, such as Moody's or S&P. You can use those to find out, what kind of credit rating a particular business might have. Anything to add, Ryan, before I move on to the private companies?
Yeah, that's great. It's interesting. Being in a different industry, we use a lot of these similar sources or different themes of sources as well. Where we have our own, we have the CTA, which is Consumer Technology Association. We have publications that we use that are focused on consumer electronics, but the themes are very similar across industry. It's just a matter of finding what versions of those sources are applicable to your industry. So I think that's a very comprehensive list.
Great, thank you. All right, so we've gotten a few questions about this. What about private companies? So a lot of times keep in mind that you're going to have to use untraditional or non-traditional avenues to get at this information. Sometimes you might only get one line from an interview or a press release that has one figure or two figures, and that may be the only information you have to start with. There are some private companies that do share annual reports, but it's not going to have nearly the level of detail as publicly traded companies. So definitely get out, start looking through the news. There are still announcements and press releases related to private companies, and you can get tidbits from there. So assuming that you might not have that information, you could also use sources like sales data. For us, a big source of information is syndicated sales data. So this is sales data gathered from your mass market retailers, your grocery stores, your convenience store channels. This is gathered by IRI or Nielsen, and you can find out how well particular businesses or particular brands or SKUs are performing in given channels and what those sales look like. So sometimes you can work some magic with those numbers to come up with estimates. Market size data, if I don't have revenue breakout, a lot of times I will rely on market size data because it's the next best thing available. Tools like Euromonitor or Global Data have this type of information where they tell you a market size, they give you growth projections, and they will tell you, say, you know, this is what the actual number might be based on their share of the market. Trade resources also sometimes provide this information specific to their industry. And then I also include launch analytics. So when you don't have performance data, you know, how else can you find out, you know, what a particular company may or may not be doing? So for a consumer packaged goods company, you know, we want to look at what's being launched, when, how frequently, has this changed over time? You know, other information do we have to support this? So examples of these types of products would be Mintel, Innova, or Global Data. And just to give you an example of this kind of a private company case study, you know, one that I've encountered, you know, I oftentimes only have a general revenue number, which might be the only thing that's released. So kind of what I start with is, what do I know? Instead of what don't I have, you know, focus on what information do I have available to me and how can I make the most of that? So what I did was I took that revenue number and then I looked at the market size data. And based on the market size data for the particular business units, I was able to estimate what share of that revenue might be attributed to each of those business unit areas. Then to fill in some of the gaps, I pulled some sales data. Now, granted, that's not going to capture everything, but you can use that kind of as a benchmark to see how close those sales numbers add up to your estimated revenue share from the market share data. And then to kind of add to that, I also looked at the launch analytics in terms of what kind of investments is that company making. So a lot of times, you know, you might be able to find some inklings on what they're spending their money on. If they announce that they're opening a new plant or they're investing in new store locations, you know, chambers of commerce love to share that information. They love to bring jobs to their community. They love to advertise that. You can absolutely use that. So I was able to look at, where did they announce that they're investing their money? What products are they producing at those specific locations? And how does that correlate with the product launch activity to figure out, you know, what brands were they investing in? So sometimes you really just need to put the puzzle pieces together and figure out how you can connect the dots. But, you know, it's never a one size fits all sort of deal. So I think that's all that we have on our end today. Ryan, do you have any closing remarks that you'd like to make?
Yeah, no, I would just double down on your, you know, the bits and pieces of information that you can gather, and then applying kind of the what if analysis or the sensitivity analysis is so powerful. You know, an example too I can think of is, if you know kind of a general, if you have a general sense for like the cost structure of the company you're looking at, and to your point, Rosie, like the market size, you can use that to maybe back into like a market share estimate. So in retail, you know how many stores somebody has or how many fulfillment centers, you can get a sense for wage rates and things like that. And then you have a market size, then you can do the analysis of like, what revenue would they have to cover the costs, and then you can divide that into the market size to get like a market share number. So it's just a lot of different cool things you can do with, you know, imperfect information and a little bit of kind of sensitivity or what if math. So just wanted to, yeah, I think you hit on a super powerful tool that we have at our disposal there. But otherwise, yeah, just appreciate the time, and I'm glad folks were able to log in and listen, and hopefully folks got something out of it.
All right, so it looks like we have about 5 minutes left to do some questions. So Ryan, we've gotten a few requests from our attendees about the PowerPoint slides. I was not sure if that was something that you were able to share with them or not. I did mention that the recording of this presentation will be available on the SLA CIC YouTube channel, and we will share a link to that recording at the conclusion of the webinar.
Yeah, the slides should be shareable. We made them, like we said, we protected the innocent, so we should be able to share them out.
Great, thank you so much. Okay, so I'm going to just move through some questions here to see what we can get through. Okay, so here we have a question. How do you get from a page of numbers from D&B or Hoover's to figuring out what amounts go where on these charts?
It's a great question. I think it goes back to you can almost use those charts or that framework as a puzzle or a set of blueprints for a company. And then you find your puzzle pieces. So Hoover's provides maybe that revenue puzzle piece, and then maybe they provide another, number of employees. Then you can start looking up, well, how much does an average employee get paid in that industry? You can back into a wage cost for the company, and then you start plugging and playing, and then you can just do some of that sensitivity math, or kind of, divide, revenue minus wages equals some amount of money left over to pay other costs. So it's really use that as a blueprint, and then fill in the puzzle pieces you have, and then kind of make up what the missing puzzle pieces are, and see where the conversation goes.
Great, thank you, Ryan. All right, our next question, if you have only 10 minutes to do an analysis, what would be the key things you'd look at to get a gut feel on financial performance?
That's a great question. So much of that hinges on what information you have at your disposal quickly too, but in my mind, it's find something to compare to. Find a revenue trend, find a cost trend, find a competitor quickly. Is revenue moving a different direction than the competitor or the industry measure? That's, in my mind, that's the quickest way to find, maybe find a smoking gun somewhere, or a red flag, is just look at a trend relative to a competitor, relative to some industry measure very quickly.
Okay, we have one about, do you have any suggestions for a more in-depth training on company financial analysis? I know I have one suggestion. So my company actually offers a class that anyone in the company can sign up for, called Building Business Acumen. And it's sort of like a 2-day workshop, and you go and work in teams, and it's all about reading a balance sheet, understanding what those numbers are like, and then you do some sort of small group work and present, your analysis to the other members of the group. I do believe there is a book as well associated with that training, but I know that was very helpful for me, and it was not like a huge time commitment or, anything, exceptionally painful, like a long-term accounting class commitment. So Ryan, maybe you have some other additional suggestions?
Yeah, I would just say there's a lot of good stuff out there. Investopedia is a great website to go to. There's a lot of cool YouTube videos. Khan Academy has some great free references you can go through. So yeah, there's a lot of great resources out there in the public domain.
Okay, hold on. Some of these are kind of long here. Okay. Do you have any articles or books that you would recommend, I guess, other than what we already mentioned?
Oh, that's a good one. I really like A Random Walk Down Wall Street. I think that gives a good, kind of gets you in the mindset of like an analyst of a company. Yeah. How about you, Rosie? I'll deflect that one to you, maybe.
I don't do a lot of recreational reading related to finance when I can help it. I do just reading through the analyst reports and the call transcripts. Like, that's enough for me.
Yeah, totally unrelated. I just started reading the Harry Potter series because my kids did. So that's an entertaining read, but has nothing to do with this presentation whatsoever.
All right. I guess we have time for maybe one more question. Let's see here. Okay. All right. This one's kind of long. I will try and read it. It says, since there are so many indicators for financial metrics, is it true that based on the psych philosophy of company leaders, that you would focus on certain important key data points to watch? How do we avoid being blindsided when these company strategies change and we only focus on key data that match with their strategies?
That is a great, deep question. I think it can work both ways. It seems like the most successful companies, and I could be wrong here, but their strategies, fundamentally don't change a lot. Their tactics might change, but I feel like their strategies are largely like some of the retailers we talked about. They're low price, assortment driven. I think what you look for is deviations, like large quick deviations in those metrics, like the example we had where free cash flow quickly deviated from operating cash flow. That would be the signal to go like dig a little bit deeper into something. I don't know if that perfectly answers the question, but it's those quick shifts in the metrics that might signal a shift in tactics or even strategy. But I feel like strategies fundamentally are largely whole for companies, but Rosie, if you have a perspective on that, I'd love to hear it too.
Yeah, no, I think that is a great question. And certainly I agree that I'm looking for sort of those deviations as a red flag, like, hey, something I should be aware of, or has this company shifted their focus? Are they prioritizing one business unit over another? And are there market indicators that reflect that? I think that those are the kind of insights that you won't necessarily be able to get just by looking at the numbers. Like you want to be able to tell that whole data story. So I think that's why, Ryan did such a great job calling out how important it is to look at both that company's strategy and their mission and what they've stated publicly that they're working towards, and weave that in within the financial narrative and not just get used to relying on the numbers for all the answers. All right. I think that wraps us up for the day. Just want to say thank you to everyone for joining us. Thank you, Ryan, for this fantastic presentation. We hope that you will all be available to join us for next month's CIC webinar on another analytics topic. And just a reminder that if you are the lucky winner of the $25, you will be hearing from us shortly. And the recording for this presentation will be shared soon. Thanks again, and we appreciate all your time and attention today.